This Friday sees the latest US jobs report, and this, of course, allows us a moment to turn our mind back to the US data following a period of volatility centering around, of course, Venezuela and progressively Greenland. So let's look at the numbers, what the market's expecting, and what could the implications be for the likes of the US dollar, the likes of gold, and US stocks. So in terms of market expectations for the Federal Reserve, this, of course, is the sort of backdrop to market thinking. So how is this going to adjust expectations? Right now, markets are expecting us to see the Federal Reserve pause for the next two meetings, or essentially come into March with a potential view to cutting rates. And so the potential implications for that view and the outlook for the Federal Reserve will be key here. In terms of what markets are expecting from this meeting, you can see here that non-farm payrolls figure is forecast to come in at 45,000. Notably, this comes off the back of an ADP report that was expected to be 49,000, and it came in at 41,000. But we're getting a little ahead of ourselves there because we'll come onto that. Unemployment expected to remain at 4.6, average hourly earnings expected to rise to 0.2%, but that's still a healthy number, or a decent number, and the year-on-year figure at 3.5%. When you see the drill down in terms of which segments are providing this job growth, it's not government payrolls, it's not manufacturing, it will be within the private sector, and again, we'll look into exactly what segment is driving any element of strength that we have been seeing recently. Notably, the U6 unemployment rate expected to rise once again. So not necessarily a great sign of that if we do continue to see the total unemployment gain ground. Of course, the dual mandate for the Federal Reserve is to keep inflation under control and to keep unemployment, or the jobs market, under control. So if we see a rise in terms of unemployment, weak payrolls figure, that's the kind of thing that pushes the Federal Reserve into action and potentially weakens the US dollar, potentially strengthens equity markets, strengthens the likes of gold if we see that. The flip side is, if we see inflation moving higher, that hinders the ability to act from the Federal Reserve, and that, of course, then potentially strengthens the US dollar, weakens equity markets, and weakens the likes of gold. We'll kick off with wages, which by and large, out of the sort of three main elements, is probably the one that's paid least attention to. It essentially is a proxy for inflation. So it's sort of underlying cost pressures in the US economy. What's notable here is that we have seen a sort of decline of late on that 3-month annualized metric. So by and large, it appears to be under control. You can see here that the pathway for wages is generally fairly well correlated with the pathway for inflation. So if we did see a spike in terms of wage growth, then of course that could potentially provide some concerns around inflation, but it doesn't seem likely. When you see weakness in terms of the jobs market, there's not necessarily the need for people to suddenly provide bumper pay rises in such a jobs market. In terms of the ADP payrolls report, like I said, worth noting, came in at 41,000. But here I thought I'd provide a sort of drill down in terms of exactly how those numbers came to be. You can see goods producing, pretty much nothing, in particular weakness in the manufacturing sector, not something Donald Trump would want you to talk about or note. Then the services sector, this is where you get some of the growth from. And most recently, one of the areas that has been the area of particular strength, as you can see once again here, is education and health services, also seeing some leisure and hospitality job growth coming into play. By and large, on the leisure and hospitality sides of things, it's the kind of thing that a lot of the time will be relatively low paid jobs. In terms of the breakdown on which segments have been doing well and which haven't, like I said, you've got that gray section, which often is a very prominent part of the job creation picture, and that is education and health services. But by and large, many of the other segments of the economy that in the past will see growth, if you look at the left-hand side of this chart, ordinarily you might see one or two segments of the economy in the negative area at the bottom, but then the rest of it all in positive territory. Well, at the moment, that's not the case. And it's only a few sections of the US economy that's creating jobs, and the rest of them are actually shedding jobs. So certainly looking at that drill down, that's not necessarily a picture of health. And so sometimes you might see a strong number in terms of payrolls, but when you look into it, in actual fact, it's really just being driven by one sector, and the rest of them are really floundering. That is not a picture of health, essentially. It's not the kind of thing that the Federal Reserve are going to be happy about and may deem it necessary for them to take action. Part of the reason why people are utilizing the ADP payrolls figure of late as a proxy for the headline number comes down to the fact that we saw the shutdown. So that, of course, made it gain importance. But also we're seeing a rolling over in terms of government hires as a proportion of the total payroll growth. And of course, the ADP figure is a private figure, so you're not necessarily going to see those government figures. Notably, under Joe Biden, we actually saw a rise in terms of government hires as a percentage of total hires. That, of course, means that they're leaning more heavily on something that would ordinarily happen within a recession. It's not normal to see a significant rise in government hires as a percentage, as a proportion or ratio, or as a percentage of the total hiring in the country. But that is coming down under Donald Trump. And that, of course, puts downward pressure on that one element within the jobs report anyway. In terms of payrolls, well, you can see here the relationship between the dollar index and the trajectory of non-farm payrolls does highlight the fact that generally, if you see weak payrolls, you're seeing a weak US dollar. That comes because of the idea that it forces the hand of the Federal Reserve. So, of course, we're seeing some chop at the moment. I did provide a 1 month lag on this for the dollar index, but then I took it back off. I mean, you can see that generally sometimes there'll be a lag in terms of the impact of that figure on the market itself, which makes sense. But generally, you can see here that if we were to see a particularly strong figure in terms of the payrolls, if we were to see a sharp decline in terms of unemployment, it provides the basis for potential upside for the US dollar. And on the flip side, if we see a really dour report this time around, it does provide the basis for the dollar to get hit once again. And finally, we're talking about unemployment. And this is the Conference Board survey. And what we can see here is this notable shift from people thinking that jobs were hard to find, were plentiful, which is the gray line, that's declining. And those finding it hard to find a job is the purple line. Remember, they're two separate axes. So you can see the figures on the right show that there's less that think a job is hard to find than those saying it's plentiful. So you can see very clearly that we're still in the realms of people saying that more people saying it's plentiful than hard to find, but it's actually narrowing very closely. But certainly within this chart, you can see that the trajectory between the two has shifted significantly over the years. And it provides this ratio that if we put it onto the next slide, here we go, we have that ratio between the hard to find and plentifuls. And when you overlay the likes of the unemployment rate, it does provide this leading indicator of the direction of travel for unemployment. In actual fact, it's taken a fairer while to get up, but unemployment certainly on the rise at the moment. So it continues to feed into that same narrative. So if we see weak jobs data, it provides the basis for potential weakness in terms of the US dollar. And that provides the potential for upside in terms of gold, in particular, if people start to factor in a rate cut in March, which, as we said at the beginning of all of this, markets are currently essentially seeing as a coin toss. So where it's a coin toss, near enough 50-50, it's a pretty good environment to see data because it means that we see significant shifts in terms of market sentiment around that meeting. Whereas if something's like 90%, 95%, then a lot of the time you don't really necessarily see all that much movement. All of that is to say that, of course, we're coming into this report with the potential for some volatility. And so let's look at some of these charts and see exactly how things are shaping up. First and foremost, this is the Nasdaq. We could say that we're consolidating, and certainly there's an argument to be talking about a sort of symmetrical triangle formation. But I would say the bottom end is a lot more convincing as the creation of higher lows than the top end, especially given the fact that we're now approaching this near-term swing high, which is at 25713. So if we break that level, then essentially this just looks like a consolidation phase and likely a continuation pattern, because symmetrical triangles are essentially the bullish or bearish view of it is essentially formed by the direction of travel coming into that. So it is a continuation pattern within this bullish trend, and therefore the breakout is likely to come towards the upside. The fact that we've broken through trendline resistance, you could say it's not a great trend line, but it's there or thereabouts with that third touch. So if you want, you can put it up here, but essentially the story is the same. What we want to see here is a breakthrough 25713. If that happens, it forms the basis of a potential strong move back up towards the prior highs that we have up here at 26255. And in particular, if we see some weakness in terms of the jobs report, how's that going to report? How's this going to make the likes of the tech sector react? Well, you do have the two sides of it. One side, people might think, oh, the economy is really weakening, and if the Federal Reserve aren't going to take action, then we have all the negatives of a weak job market and that we don't have the positives of the Fed. But if it does shift market expectations and raises expectations for a rate cut in March, and in particular, if we see commentary around that, then it does form the basis of a potential bullish outlook for the Nasdaq. Then in terms of the US dollar, one sort of long-term view worth looking out for is this monthly time frame chart, which highlights the fact that we've come into a really crucial area of support. And at the moment, we've held up. You can see this low provided that rebound in towards the back end of the year. Sharp decline in December, but now holding up a little bit at the moment. Let's just work our way into the charts. You can see here we've rallied up, crucially, just tentatively breaking through your first swing high, which is around your 100.257 mark, and now heading lower. The key thing here is, do we break the previous low or do we not? If we do, then it looks like things are going to continue on this bearish mindset that has been dominant throughout Donald Trump's, I want to say reign, but second stint in power, essentially. So we're pulling back. There's question marks on whether we bottom out because we've got trendline support, and we've got, of course, this rally up through your swing high, which forms the basis of a potential retracement coming into play. So look out for some of these fib levels as possible support. I'm going to add the 61.8 as well. And you can see that actually we've tagged that 61.8 perfectly as things stand. So certainly the dollar index is going to be a really key one to be watching out for around this release. 97.807 at the moment, providing the low. We're moving through that swing high. Certainly, if we were to see strong data from this jobs report, it provides the basis for potential optimism around the economy, but also that cautious approach from the Fed likely to continue, that March rate cut unlikely to come to fruition. If we see weakness, then it provides the basis for a potential rolling over of the US dollar once again. And finally, looking at gold, we're actually seeing it breaking through support at 4442 at the moment. Once again, if we see weakness in terms of the jobs report, it points towards the need to act more at the Federal Reserve. That again really sort of highlights the focus of a potential loose monetary policy going forward from the Federal Reserve. So that would likely lift precious metals. The flip side of it is strong data likely does the opposite. We also have a number of other drivers, so I wouldn't necessarily say it's all just going to come down to the jobs report in particular. We've seen this strong move coming off the back of that sort of Venezuelan news. We're now starting to roll over a little bit. I just think in my mind that such a move lower would be a likely retracement phase. And if we do break through this low, which at the moment looks like we've pretty much done, then you could possibly come into this realms of sort of 4360 up to 4400 before the bulls come back into play. Ultimately, I still remain very positive for this market, with a breakthrough 4273 required to start to turn the corner on this bullish trend that over the near term has been playing out since these lows that you have back here in sort of mid-November. But of course, this bullish trend goes way back beyond that. I hope that's been useful. Make sure to like and subscribe, follow for more content like this, and make sure to keep your eye out on Friday's jobs report out of the US.